Welcome, everybody. This is Marc Jimenez, Wealth Advisor and Chief Investment Officer for CAM Investor Solutions. Thanks for taking the time to join today. Today, we have a very special guest in Nancy Davis with Quadratic Capital. She's located in Greenwich, Connecticut. Nancy Davis is the founder and managing partner of Quadratic Capital. She's also the Chief Investment Officer. And in her current role as portfolio manager, she's also serves in that role for the Quadratic Interest Rate Volatility and Inflation Hedge ETF, ticker IVOL, which has been a fantastic and more unique solution, which we'll talk about later. But really, in some background on Nancy, she founded Quadratic in 2013, but she's had a very extensive career in a lot of different roles in the industry. She spent over 10 years at Goldman Sachs, where for the most of that, she pretty much oversaw head of credit derivatives and over-the-counter trading. And prior to that, she worked in other significant executive and portfolio management roles in the industry, which obviously, utilized her great experience. She's well known in the media community, from Bloomberg to CNBC to CNN, and has written a lot of different articles for publication as well. So we're happy to have her. Thank you, Nancy. Welcome.
Thanks for having me. Great to be here today.
Absolutely. Nancy, I thought it would be great to have you on because there's been so much, not just going on currently, which we'll get into later, but given a lot of what you get to see every day and what you do, not just in terms of the fund you manage or funds you have managed in the past, but the things you're exposed to. So I thought it'd be good to talk about some of these different areas today while we have you. It's been an interesting 3 to 4 months. I think the last time we saw each other was on March 12th at the NYSE, right as everything was starting to happen, we'll call it, and how things have, the world has changed a little bit since then. So one thing before we dive into some of the details and kind of what's going on in today's world, for our audience today, maybe just share a little bit about, you do a lot of work in fixed income and bonds. Maybe just talk a little bit about what do you see as really the drivers of performance when it comes to fixed income and bonds, all things.
Yeah, no, it seems like times are so different because Marc and I, fun fact, we actually were the bell ringers on the New York Stock Exchange on the worst down day since 1987. And it was actually the last day that the New York Stock Exchange had anyone ring the bell. So then they closed the exchange. So I think when they open up the history books, Marc, and talk about the crash of 2020, there'll be a photo of you and me. So pretty crazy times. So yeah, it's definitely been a challenging time, especially in the first quarter for many investors, because I think they had sort of a rude awakening that the diversification that they may have thought they had in their portfolio wasn't actually working. So you saw many portfolios, especially in the fixed income market, that were supposed to diversify the equity risk, actually trade off with equities in Q1. So I think it was a shocking quarter for many investors, and I think woke people up to the reasons that you want a well-diversified portfolio.
Absolutely. And, we've seen that things change over the last, not just in this event of recent, but given the last, not just 5 years, but 10 years perhaps. Here at the firm, we do a lot of planning, not just for individual clients we work with, but also some of our institutional clients who rely on us for things like assumptions for inflation, assumptions for expected return for different asset classes. Given, for example, you manage IVOL, which is an ETF strategy, which is pretty unique. I'm curious to get your thoughts on, given all the federal stimulus, given all this collapsed yield environment that we're in, and given that yields are at generational lows, what should investors be thinking about, not just now, but going forward?
Yeah, it's a really difficult time to be a fixed income investor because government bonds are near their all-time, most expensive levels, with the 10-year currently at 65 basis points. So it's never been more expensive to own duration in the portfolio. And I think the risk reward has never been worse, even in, the super bull case scenario, if 10-year yields were going to zero, the most you could possibly make by owning long duration bonds is, 5 or 6%. Whereas if the market normalizes and we stabilize to like the equity markets already have and the credit markets already have, you can lose 15 to 20% in price terms really quickly. And then if you look at the credit markets, obviously we had a huge credit sell-off in the first quarter, and then when the Fed stepped in to stabilize credit by buying credit ETFs, the market has completely normalized in credit. So credit spreads have tightened in the second quarter, and I think going into the third quarter, there've never, I think, been more challenges for investors, especially when you're looking at fixed income.
Yeah, and I think, we talk to, and in addition to planning and investing, we like to manage risk for our clients. And right now you mentioned something, not just all the money in motion with the Fed, buying ETFs, but also the money in motion that's going into different areas of just the bond market, which we're seeing these yields, as you highlighted, being pushed down to, close to zero in many cases. I've heard you use the term in the past, and again, nobody has a crystal ball, but I've heard you use the term in the past, the bond market is screaming, right? Which I like, because it gets your attention, one, but also right now you've seen areas of the market, technology hitting new highs of late, other areas of equities maybe not recovering as quickly, but bond yields, I feel like, not just in the US, but globally, continue to just go lower, right? They're inching lower or staying very low in most cases. I mean, what does that mean to you? I'm just curious.
Yeah, so that comment, the bond market is screaming, is definitely talking about the 10-year treasury. The 10-year treasury in many asset allocation models is considered the risk-free rate. And 10-year yields right now being around 65 basis points, it's screaming to the market, go risk off. It's not saying take equity risk. It's not saying take credit spread risk. If you just look at the 10-year rate, it's saying, the world's about to end. I mean, it's crazy how expensive government bonds are. And now policy rates are very low, but normally the yield curve has about 2 to 2.5% difference between front-dated policy rates and long-dated rates. And it's not normal right now because it's so flat. And that's largely a result of, I think, investors' expectations almost uniformly right now think that there is going to be deflation in today's environment. And you're seeing that as a result of why people are willing to own duration with such a bad risk reward at this level of yields.
Yeah, I mean, that seems to be a tough equation. I think, and one thing with all the stimulus from Federal Reserve and Congress, going forward, I mean, what you do with one of your strategies is think about interest rates day in and day out and the shape of the yield curve. In the current events, excluding, the COVID world for right now, just looking at yields, what kind of risks do you think might exist that investors might get compensated for? I know it's hard, right? You highlighted that, but what might investors actually get compensated for in taking risks, especially in fixed income?
Yeah, I mean, maybe I can break up fixed income into two segments. First, there are things with credit spread risk. So floating rate notes, bank debt, investment grade, high yield bonds, distressed, anything that is subject to credit spread risk is its own little, it kind of has a beta that's similar to equity beta, because when equities sell off, credit spreads tend to widen. Then there's a class of investors that have mortgages. I think many investors in mortgages don't actually realize that by owning a mortgage, they're actually short volatility. That's because the homeowner in the US can prepay their loan whenever they want. Therefore, the owner of the mortgage is short that option to the homeowner. So as we saw in the financial crisis, when you have market stress, mortgages tend to lose money in price terms. And so I think a lot of the passive fixed income investors, like for instance, the Barclays Ag Index, and I know we've talked a lot about this, but the Ag is a third mortgages. And I think people have no idea that they're actually short vol with that mortgage exposure. So credit, mortgages, and then the third bucket would be treasuries. And then there are kind of three main buckets within subcategories within treasuries. There's, people who own long duration, which, most people who own long duration are trying to hedge their equity risk. People who own short duration, which are generally the folks that are worried about higher interest rates and losing money in bonds. And currently it's about 15 basis points to own short duration. So you get paid nothing to own that bucket. And then the third would be the inflation protected treasury bucket, where that's tied to CPI, which is the US government setting what inflation is. And about a third of CPI is shelter, as defined by rent, which is largely irrelevant for most investors' duration risk. So I like to think of the fixed income markets as kind of those three, the credit markets, the mortgage markets, and then the treasury markets with the three subcategories of short duration, long duration, and inflation protected.
Okay. No, that's great. And we highlighted, I think, a little bit earlier, credit can be tied somewhat to equity markets, correct? We know that there's some correlation, and we've seen that. We saw it on March 12th, especially. I'll come back to inflation protection because I would be doing a disservice to our audience if I didn't jump into that topic with you, especially given what you do and your experience there. But talking about, I think, just bonds right now, because I feel like we come across investors on occasion where they might be still taking duration risk and not getting paid for it, whether it be in some larger fund strategies, given performance has been great because rates have just come down. I mean, why should somebody, if they should, own any kind of duration in this market?
I think many investors still own duration, and you can definitely see that because of how expensive treasuries are, especially the 10-year at 65 basis points. It's really crazy in many ways because the risk reward, even in the super bull case of negative rates or interest rates on the 10-year point at zero, we probably have negative policy rates at that point. It's really bad. It's kind of skewed all the wrong way. But the long story short is many investors have been rewarded for owning duration over the cycle. And so I think most investors have something that looks like a 60-40 portfolio where they're using their treasuries to try to hedge their equity exposure. And I think that's an unknown, especially with the global pandemic and now having fiscal spending in the equation. We just spent $3 trillion on fiscal spending, which is about 14% of GDP. And the Fed seems completely not concerned about inflation. They're just trying to get the unemployment rate lower. But I think it's a really tough environment because, you could have unintended consequences from handing out so much money. In my mind, I look around me and there are all these help wanted signs, and you kind of wonder, like, are people choosing not to go back to work because they're getting paid more just to stay at home and, play video games all day? So it's really unknown, whether the economy is going to be able to reopen and we're going to have a V shape or U shape or any type of recovery. Then those owners of long dated treasuries at 65 basis points are probably going to lose quite a bit of money in price terms. Or are we going to not have the economy reopen, try, start, fail, and the Fed might be looking at other policy tools like yield curve control or negative interest rates, NERP, to try and stimulate things and keep the financial system going. So
Yeah, that's a really interesting thought because especially, I mean, with the stimulus, with the provisions being made right now and the unknown and just the yield levels, again, coming back to that, I feel like related to the stimulus and the issuance of bonds taking place and this whole yield curve topic or yield curve control, I mean, there's different terms I feel like every day. What's going to stop the yield curve from changing its current shape? And I mean by that is, like, there's talk of just causing it to normalize and the longer end become less flat than it is now. I mean, can the federal government, in your opinion, control that, or will that just be a function of markets?
No, I do think the Fed is able to control it. I mean, I do think the reason that we have such a very, very flat yield curve right now is really from the last crisis that we had, which was with Greece and the European debt crisis that really started at the end of 2011 into 12 and 13 when the Fed implemented Operation Twist. In Operation Twist, they bought long dated bonds and sold front dated bonds, and that flattened the yield curve because we were already at the zero bound in terms of policy rates. So I think the Fed definitely is able to use yield curve control, use their ability to invest in treasuries to help, stimulate. And I think right now they're trying to stimulate the transmission mechanism of money from the Federal Reserve, from the US government to the banking system, and to get it, to disperse it to Main Street. At the end of the day, the reason that they're doing all of this is to create jobs, get the economy going, prevent this global pandemic from, turning the markets into recession. We went from one of the lowest unemployment rates in history to one of the highest in a very, very short time period. So it's a huge shock to the system that they are trying their best to accommodate.
And that's a good point, because I think there's goodness out of that. They can't control some things, but you're right, there's uncertainties that are existing still. Kind of going forward with inflation, because it's a big, big topic. I feel like until 2 weeks ago, people have forgotten about it again until all of a sudden. But we know rates are really low. We know rates are zero bound, let's call it, and the risk premium or the risk-free rate is what it is. And it's one argument to discuss what expected return should be. But ignoring that for a second and just get into the inflation discussion, there's different ways to measure inflation. There's different arguments about ways to measure inflation. It seems like the market might be waking up to, hey, maybe there might be some inflation, even though I know you've been arguing that and telling people, hey, this can happen. Like, maybe talk a little bit about what we're seeing right now when it comes to inflation risk, or the market's pricing that in even.
Yeah, it's pretty peculiar to me because the rates market is almost uniformly thinking the pandemic is going to be deflationary. And I guess being a contrarian investor, I think owning inflation expectations is very cheaply priced, because you have 99% of the world thinking the outcome is known. And I think the one thing I've learned over the course of my career is when everybody thinks something is going to happen, usually it doesn't happen. A good example, like just think about December 2018. The US rates market had priced in 3 hikes in 2019, right? Kind of universally, everybody was expecting the Fed to hike 3 times in 2019. And reality was they cut 3 times in 2019. So I think it just goes to prove that you really don't have any crystal ball. Nobody can predict what financial markets are going to do or what policymakers are going to do, but you can look at what the probability distribution is priced in. And right now we are at extreme levels, in my opinion, of thinking that the pandemic is going to be deflationary, and therefore it is priced appropriately in the rates market. And you can see that with the level of the US yield curve. If you think about what the yield curve is, it's just the difference between 2 interest rates at different points in time. I think the best way I describe it is if, Mark, if you went to, or your clients went to a bank and they opened a CD with any bank, and they said, all right, how much yield will I get for a 6-month CD or a 3-month CD? Okay, well, that's not very much. How about a 10-year CD? Right now, you get paid less than half a percentage point to lock up your money for a decade. And that's because there are very little inflation expectations in the future. So I think the yield curve is really a measure of what investors think will happen in the future.
That's interesting. And to while we've talked about bonds and duration and different things that you might get paid for and not get paid for, with inflation, given these deflationary or inflation expectations, there's talk that maybe there might be some ways to help investors hedge against that or protect against some of those unknowns that you just highlighted. One of the most common ways is tips. We'll hear about tips. Some people hate them, some people love them,
Yeah.
but they're tools that utilize CPI and some other measurements to factor in. What are your thoughts on tips in general for investors?
So I do prefer tips over nominal treasuries. Tips are just US treasuries with the protection component versus a nominal treasury has no inflation protection. Tips were created in the late 90s by the US Treasury. We've never had any inflation since tips were created. So I think the jury's out on whether they will work or not. I do think they are in the spectrum of, credit, mortgages, and treasuries. I do think they are the most attractive out of those three buckets, in my opinion, in the fixed income space. But I do think tips alone are lacking because they give you, it's tied to CPI. And again, CPI is set by the US government. It's their basket. It can change anytime. And it doesn't take into account many things that are, real in our lives. And at the end of the day, I think investors need to be mindful about, protecting their wealth. Everybody wants to live a long and healthy life, but you don't want to be outliving your wealth. And so whether you're the biggest deflationist in the world and you think bonds will be bid forever, that's great. But I still think every investor should have some type of inflation protection in their portfolio, because you don't want to make that bet that you lose purchasing power, especially when we've had a very, very strong dollar and it's very unclear what's going to happen. It is a global economy. We have a lot of foreign investors in our treasury market, and I just don't think you want to make a big bet on making sure that you had enough money over the course of your lifetime.
Yeah, I mean, that's a good point, because I know folks thinking about retirement, in retirement, protecting purchasing power, even institutions in some extent trying to protect levels of pension wealth and income, utilize strategies like you just mentioned. Kind of shifting gears to today's environment. Again, we're not health experts. I know I've heard you say it. I've said it to our audience. We don't know what's going to happen with COVID-19. But it seems like there are things that exist that are risky. There are things that could happen that might present risks to investors depending on how they're invested or how they're positioned. One of the things I think about isn't so much, okay, the Fed's announced rates are staying low for long or forever, whatever the cliche is today. But ultimately, I think there could be some natural market forces that just a normal yield curve shape, a normal yield curve environment where the longer end becomes a little bit higher than the shorter end than it is today. If that happened, what kind of risk would exist or would present themselves to an investor?
Yeah, I mean, in that environment, obviously owning longer duration securities, they will lose money as interest rates move higher, the price of bonds will drop. That exists in mortgages, in credit, because credit doesn't hedge rates, and also in any type of nominal treasuries. So it is a really challenging time, because if you're of the mindset that the economy will recover, and whether it's a U shape, a V shape, whatever shape you think, you don't want to own long duration treasuries or have that rate exposure in case of a normalization. And I think the key is you really don't need there to be inflation. You just need there to be a normalization of the rates market. Just the expectations, not having everyone universally think the market will be in a disinflationary environment. So whether inflation happens or not, it doesn't really matter. I think, look, if you look back at 2014, for instance, or 2013, this is even after the Fed had implemented Operation Twist, the US yield curve was about 250 basis points, meaning you go to the bank, you open a CD, you give the bank money for a decade, it was just normal to get paid 2 to 2.5% more to lock up your money for 10 years. That wasn't, if you assume, a 2% inflation level, it wasn't some abnormal thing. And I think that's a kind of exciting opportunity, is looking for things in the market when everybody thinks a certain way. Taking the contrarian view is usually pretty cheaply priced.
Yeah, and you bring something up about managing risk and identifying opportunities. I'll come back to that in just a second. With that yield curve, given the price fluctuations, and I would feel like just for it to normalize, like you said, that the longer end go higher, I feel like there's a lot of people out there that would want to see that happen in a kind way, we'll call it. Probably I think banks probably want to see that happen just because they make more money lending in a normal way. So there's probably interested parties who want to see that happen at some point. Maybe it's a matter of how and going forward. Is there other risks? I know one topic that's been brought up about inflation, changing shape of the yield curve. Let's say real estate. Everybody owns a piece of real estate, probably in their house or somewhere else. Is there a risk by things happening either quickly or slowly to the yield curve environment, to real estate even?
Yeah, no, it's definitely a risk for real estate investors. You would essentially want to have wage inflation happening at the same time as long dated yields are moving higher. So, because so many people borrow money to own real estate, you don't want to have just yields move higher on their own, because it would make the cost of borrowing money, it would make homes less affordable if you're using borrowed funds. So it's definitely a kind of balance that you have to play. I think it's also a challenging time for real estate, especially commercial real estate, with the second derivative effects of COVID. Whether people are going to need as much office space, whether the footprints are going to be the same, whether we're going to have, a really change with the way people work and the way where people work. So I think there are a lot of unknowns in the real estate market generally. And I think that the sad thing is that most people don't hedge real estate at all, whereas most professional real estate investors, they all hedge rates, right? That's just a cost of doing business for a real estate investor, whereas most regular people just sit long. So it's a challenge for investors to figure out what's going to happen. But I think given how low interest rates are and given how flat the yield curve is, it's a good opportunity for investors to be thinking about, how could I potentially hedge my real estate holdings? What would happen to property prices if mortgage rates were 6% or 9%, or if we go back to a stagflationary inflationary period, what would that do to property prices? And obviously nobody knows for certain, but it seems like a good time to be adding hedges, at least to me.
Yeah, and I think in a traditional marketplace, sometimes that hedging ability you just highlighted isn't as well known to a lot of investors, or well known on how to do that. So there's definitely ways beyond just, let's call it stock and bonds. I mean, what asset classes, in your opinion, provide opportunities? They're not for everybody, of course, but what opportunities might exist in some of these asset classes to hedge real estate or other just present day risks we're seeing right now?
Yeah, so my expertise in the volatility markets. I do think interest rate volatility, specifically the kind of interest rate volatility that we own inside the IVOL ETF, is very attractively priced. We've seen an increase in volatility across most asset classes in 2020 with the pandemic, but this type of vol is very, very low. It's under 3 basis points a day. So I think it presents a attractive hedging opportunity for people, because the cost of volatility that goes into the option pricing model. So basically, the lower vol is, the cheaper the option is, the higher the volatility is, the more expensive it is.
Right. Yeah, and I think with eyeball the strategy, it's brought a lot of opportunities to market for investors to have access to something like the rates market, right? It's an ESG solution. So it's been a great, I think, given all the awards and everything that's happened, I think, over the last year, especially. But kind of shifting to the current environment and keeping in mind what some of the things you just said, if I'm an investor, beyond just hedging risk, I kind of heard a minute ago, and I think I've heard you say this before, given where markets are at in the traditional equity, we'll call it, or in fixed income, where's the value? If there's value potentially out there for investors, not just diversifying their risk, but potentially finding value, does it exist today? Or might it be out there for some investors who have a need for inflation hedging, diversification, and whatnot?
It's definitely a challenge for investors because stocks are, especially some of the tech stocks are near all-time highs. Government bonds, globally have never been more expensive. Credit spreads are incredibly tight, meaning, you're not compensated a lot to take credit spread risk. So it's really a challenge for investors to say, where is there value in the market? A lot of people, when they talk about value, they talk about the equity markets. Being a fixed income expert, I think there are other types of value plays. Personally, I think inflation expectations are a good value play because everybody thinks there's going to be deflation. Therefore, taking the contrarian side is cheaply priced. I also think interest rate volatility is a good value because you've seen an increase in equity vol, credit vol, any market that has an options market has a underlying volatility market. And so you've seen this huge increase in vol across most asset classes, except interest rates. That's one of the few, I'd say, value pockets that I see in fixed income.
No, that's great. Yeah, I mean, that's something that, especially for those who need to own that potentially for protection. We talk a lot about that, I know, with our clients, and it's a piece of the portfolio. I know we've had you for a few minutes here, Nancy, but just one, I think, last question. I'm always kind of even in the light of today's environment and working from different locations or home a lot, I like to finish, I think, on a positive note. In addition to finding value, I think, in the marketplace, I mean, what else can investors be doing right now? I mean, if you're saying, hey, there's opportunities, there's certain things that we all should be doing as individuals, institutions alike, what would that be to the audience today?
Yeah, I mean, I'm not a financial advisor, but I personally, I think, it's important to have an asset allocation plan, to work with you and your team, Mark, to have a plan and stick to it. I think investors can get really caught when they try to time the markets or try to predict what, even if you had a crystal ball and you knew what policymakers were going to do, you might not be able to make money because oftentimes if the market sees that coming, the market has the opposite reaction. And we've seen that over and over again, whether it was Brexit or the US election, or, there's so many times that I think just sticking to the plan and creating a diversified portfolio and not don't panic, don't get greedy, just try to stick with the plan and use, professionals like your expertise, Mark, to say what is the long-term view and stick to it.
No, I heard sticking to the plan. I like that. And we use that phrase a lot. So Nancy Davis, founder of Quadratic Capital and manager of iVol. Thank you so much for your time today. Obviously, a lot of great information. We appreciate it. And we'll have to have you back on again soon once we kind of see how everything progresses in the months ahead. Thanks again, and have a great day, everybody.
Thanks, Mark. Thank you.